Ladies and gentlemen, welcome to another Little Fish session with Law and the New Order. We will talk about the white papers and asset-based tokens. So I'm giving my time to Batuhan and Asena. Yeah, thank you.
Thank you, Jem. I will be sharing my screen, but I will be needing authorization for that.
Just a second. I'm on my iPad. I'm sorry for that.
It's fine.
Yes, I think you should be able to.
Yes, perfect. Okay, so the first topic will be white papers. And I will start immediately. Okay, so let's talk about white papers, which have been, white papers are around since the 90s. They are basically reports that companies use to show off their products or services to potential customers. So they're all about explaining the company's ideas and giving detailed information about their products. So these papers are usually used for business-to-business marketing, giving manufacturers or retailers all the deets on how to use the product or service with lots of stats and reference to back it up. So white papers come in different types and formats when it comes to project documentation. For instance, problem solution white papers address specific issues and suggest solutions for the target audience. On the other hand, some white papers simply focus on informing readers about a certain issue or debate. There are also white papers that offer technical assessments and promote specific products or services, or provide purely technical analysis on a product, service, or technology. So the question is, how crypto asset white paper is distinct from other project documentations? So when it comes to white papers about crypto assets or blockchains, they usually dive into the technical, economic, and philosophical stuff. So they're all about things like tokenomics, consensus mechanisms, and cryptography. On the flip side, regular white papers typically tackle a specific technology or a solution to a tough problem. So crypto asset white papers actually have a pretty big impact on the fundraising part of the project. So unlike regular white papers that aren't really used for fundraising, crypto asset white papers are often created specifically for that purpose. So when it comes to deciding whether or not to invest in a crypto asset or blockchain project, the white paper is usually the only thing that we have to go to. It's unfortunate, but investors and even regular customers only have the white paper to rely on for information about the project. So that's why the white papers of crypto assets are very important for the success of a project. So additionally, regular white papers are usually released by conventional legal entities that are established and well organized. So however, when it comes to a crypto asset and blockchain project, the developers typically don't have legal entities. These projects are often created by individuals who are governed by different jurisdictions and don't have a legal entity backing them up. This lack of legal entity can sometimes lead to trust issues. In this sense, crypto asset white papers serve as helpful tools in establishing trust between developers and investors. The next question will be, why do white papers matter? The white paper, the matter of the white paper, the main thing is because most crypto asset blockchain projects don't have official organizations. The only trustworthy info we have about a crypto asset is the project's white paper, as I mentioned before. So white papers are super important when it comes to legally evaluating a crypto asset. The government agencies usually check out the white papers to decide if a crypto asset is legit or not. So any mistakes in the wording could have legal consequences and slow down the project's process. So if you try to create a paper that goes against the laws of a country, the government might probably step in. So for instance, in Turkey, they don't allow the use of crypto assets in payment systems at all. So if a crypto project's white paper includes using their crypto assets for payments, the government will definitely notice, and probably they will take an action against the project. Also, a lot of places are worried about keeping customers safe with crypto assets. So the European Union, for instance, they made a set of rules called markets in crypto assets to make sure crypto asset issuers give customers and investors the right information. So it's really important to check if the place you're in has any rules or guidelines for the white papers if you want the project to do well in the future. Let's talk about the characteristics as well. So crypto asset white papers can be thought of as documents that explaining the underlying blockchain technology, any smart contracts involved, the goals and the purpose of crypto assets, any rights or opportunities given to the buyers, the project timeline, and the team behind the project. So white papers are similar to offerings, circulars used in public offerings in the capital markets, but they're not exactly the same. The first thing you will see in a white papers, they are generally is talking about the problem. So figuring out the problem is the first step to grab the attention of investors and find a solution. Another typical thing you'll find in crypto asset white papers is suggesting a practical solution to the problem. So then the focus is on convincing people to invest in the crypto asset and support the project. Crypto asset white papers almost always represent a business plan due to their common use in the ICO process. In terms of token economics, there are some questions to be answered. So the main questions you should ask will be, what are the main features of the crypto asset? And what can the buyers do with them? How will the money be used? When do you expect the project to be finished? And when do you want it to be finished? When will the tokens be issued? And how many will there be? How will the buyers get the crypto assets they're supposed to receive? And for example, how will the tokens be given to the people who buy them? How much money is needed? And if the project doesn't get enough, how will the buyers get their money back? So you have to check those questions and answer them, and try to answer them in the white paper accordingly. Let's talk about legal and regulatory disclaimers, which is very important for a white paper to have. Every white paper should have a disclaimer right at the beginning. So this disclaimer is super important because it protects the folks who wrote the white paper from any legal trouble. You should probably mention in a brief way that the company and its team members aren't responsible for any claims related to the white paper. So you make sure to clarify that the company, team members, distributors, etc. won't be held liable. Also mention that they won't be responsible for any losses or damages that might happen when accessing the white paper. So in the world of crypto asset service providers, it is important for white papers to have a disclaimer saying they're not giving any financial, legal, or tax advice. We might also need to mention that the white paper and its contents haven't been checked by any government agency. Also, it's possible that certain places might completely outlaw crypto assets. So that's why it's also important to reach out to the people in those areas, in those jurisdictions, and let them know not to read, distribute, or share the white paper there. So, and if they happen to be in one of those places, we should warn them that it's their responsibility to cut ties with crypto assets and the white paper. Otherwise, liability may arise towards you or the team members or whoever who is included. Let's talk about risk appraisal. I cannot pronounce this word correctly. Okay. Risk appraisal or appraisal. Can someone help me with this?
Appraisal, I think.
Yeah, I am correct, right? Okay. Okay, risk appraisal or risk assessment is a way to evaluate and analyze potential risks, uncertainties, or vulnerabilities that might be associated with a project. So while not all crypto assets or blockchain projects have significant risks that require a formal risk appraisal, it can be helpful to include a simplified version in the white paper. So this would involve identifying and analyzing risks, as well as outlining strategies for the project team to address them. The whole point of risk appraisal is to carefully figure out, measure, and grasp the possible outcomes of risks and help potential investors make smart decisions. So when assessing the project's risks, we might need to look into different regulations surrounding crypto assets. So these regulations can be at different stages of development and may even restrict their use in certain ways. Another thing to consider is the market volatility in crypto assets. So these markets are notorious for their wild ups and downs. Basically, the value of the crypto asset could change a lot, and that could make investors feel unsure. To deal with this, the project wants to build strong partnership and community that will help stabilize the value of the crypto assets during these crazy times. Okay, let's take a look at the role of white papers in crypto asset launch. The white paper is like a starting point for people who are interested in investing or using the new crypto asset or token. So it's a way for them to learn about the project and brush up on their knowledge. So the white paper acts as a resource explaining the technology behind the crypto asset and the goals of the project. It also helps potential investors understand the project's team and roadmap, promoting transparency. The white paper can give investors all the nitty-gritty technical stuff they need to know before throwing their money in. So plus, it's usually covers details on tokenomics, like how tokens are distributed, the supply, mining, and creation, and what incentives are in place for miners, developers, or stakeholders. The white paper can also be used as a way to promote and market the crypto asset project, attracting investors and community members by effectively explaining its value. This helps create a roadmap for the launch of crypto asset, building confidence among investors and growing the community, ultimately helping the project compete in a tough market. Okay, thank you all for listening to me. Now I will leave the word to Batuhan.
Thank you, Asena. Thank you for the extensive information you have provided. Now I will be talking about established guidelines for white papers. First of all, markets in crypto assets regulation, also known as MiCA, is a leading legislation regarding crypto assets, their offerings, and documentations regarding to these crypto assets, and many other things. Since MiCA will have a huge impact on the regulatory aspect of blockchain technology and crypto assets in various countries and jurisdictions, we shall closely examine MiCA. With regards to white papers, MiCA regulates and addresses different types of crypto assets, and those crypto assets are categorized as utility tokens, asset reference tokens, and e-money tokens. MiCA mandates that market participants must publish a white paper before making any crypto asset available to the general public, meaning that offering a crypto asset. According to the Article 4 of MiCA, for a person to make an offer to the public an utility token, a crypto asset within the European Union, that crypto asset shall have a white paper and must be drawn in accordance with Article 6 of MiCA. And if the offer to the public of the crypto asset concerns a utility token, if the crypto asset that is wished to be offered to the public concerns a utility token, and that utility token provides access to goods and services which are not yet which do not yet exist or have not been put into operation, the duration of the offer to the public described in the white paper must not exceed 12 months from the publishing date of the white paper. Also, it is important to note that requirement of issuing a white paper prior to the offering to the public is not mandatory in some cases, and these are the scenarios where offer to the public is made to less than 150 natural legal persons per European Union member state. And if another one is over a period of 12 months, starting with the beginning of the offer, the ICO, the total consideration of an offer to the public of a crypto asset does not exceed 1 million euros or the equivalent amount in another official currency or in another crypto asset. And the third one is an offer of a crypto asset addressed solely to the qualified investors. And in this scenario, only the qualified investors will be able to acquire this crypto assets. And in this case, you will not be obligated to issue a white paper. Furthermore, according to the Article 6 of MiCA, a crypto asset white paper must contain several information. The first one is the one offering or seeking admission to the trading. There shall be information about that. And also, if the issuer is a different person than the offerer, then there should be also an information about the issue. The operator of the trading platform for the crypto assets, in cases where it draws up the white paper, in this case also an information shall be present regarding the trading platform. Furthermore, information on the ones who has drawn up the white paper, and of course it's for the scenarios where the white paper is drawn up by a different person, even by a third party. Also, detailed information about crypto asset project itself shall be present. The offer to the public or its admission to trading and information regarding this matter shall be present. Detailed information on crypto asset itself and the rights and obligations attached to that crypto asset shall be also mentioned. Moreover, information about the technology that underlines the project, what is new about it, what is that technology, and etc. shall be mentioned. Also, there shall be a risk analysis stating potential risks about the project. One other interesting thing is MiCA requires issuers, offers to put information about principal adverse impacts on the climate. So, some consensus mechanisms require a lot of energy, and and we know that these consensus mechanisms require a lot of energy, which actually have an adverse impact on the environment. So it should be also mentioned that the information I have just talked about required in the white paper must also be fair, clear, and comprehensible, and shall be void of any misleading language, and must not contain material omissions or any assertions to future value of the crypto asset. So basically, you just can't say that we predict that the value of this token will be $5 in 2025. You can't just do that. Furthermore, MiCA's Article 6 also constitutes that crypto asset white papers shall contain the following statement on the first page, and I will directly read this statement. Let me check my notes. Yes, now I will read you a passage, and this passage shall be put at the beginning of the white paper. This crypto asset white paper has not been approved by any competent authority in any member state of the European Union. The offerer of the crypto asset is solely responsible for the content of this crypto asset white paper. The white paper must contain a statement from the entity's management, the team that develops the project and the crypto asset itself, the applicant for trading approval, or the trading platform operator, confirming that compliance with Article 6 and the accuracy and truthfulness, correctness of the information presented in the white paper. The white paper should also have a clear, non-technical summary of the offering or trading admission, including a warning that it is only an introductory overview, and also shall state that potential buyers should review the entire white paper. Yes, there should be a summary, but the summary also states that you shall look into the entire white paper before making any decision. It should clarify that crypto asset offering is not a solicitation to buy financial instruments. So it is not an advice, and the white paper does not qualify as a prospectus. Also, there's another required statement, and this is where expresses that the crypto asset may lose its value partially or fully, that the crypto asset may not always be transferable, crypto asset may not be liquid, crypto asset is not covered by investor compensation schemes, and the crypto asset isn't covered by deposit guarantee schemes. So it is all for warning the investor, the purchaser, the consumer of the crypto asset about the things they should be aware of. Moreover, white paper shall contain a statement from the management body of the offerer of the utility token stating that the information presented in the crypto asset white paper is fair, clear, and not misleading. So MiCA basically wants everyone to state that the responsible people regarding white paper, MiCA wants these people to clearly state that I drafted this white paper, I checked this, all the information is fair, accurate, clear, and we are not misleading you. Okay, moving on, the liability arising from information utility token white paper is a crucial matter. According to the Article 15, if I'm not mistaken, in the event of information contained in the white paper is wrong, contrary to the rules, which basically means that information given is not complete or inaccurate or fair, then the offerer of the ICO, initial coin offering, or the other relevant natural or legal persons will be held liable to the holders of issued crypto asset for any loss incurred due to such infringement. Furthermore, it's important to state that any contractual exclusion or limitation of liability stated in a white paper will have no effect in accordance with the infringement. So, let's say you drafted a white paper and you present misleading, unlawful, incorrect information, and after that you stated that we will not be held liable for any misleading or etc. information. MiCA clearly states that and avoids that by stating that it will not be legal, it will not have any effect in terms of law. So it is one other thing that we should be aware of. Now I will move on to asset reference tokens and their white papers. According to Article 19 of MiCA, an asset reference crypto assets and the white paper regarding to it must contain information about the issuer of the asset reference token and the asset reference token itself. Furthermore, it requires that information about the offer to the public of the said crypto asset reference token, or its admission to trading, and information regarding to that shall be present. Also, rights and obligations attached to the asset reference token, underlying technology, under possible risks, or the reserve of assets that asset reference token is actually backed, and information on the principal adverse impact on the climate, as we said on utility tokens, shall be present. And all the information that I just mentioned are required to be present on asset reference token white paper. And these information also shall be fair, clear, and not misleading. Moreover, it is expressly forbidden to provide any assertions regarding the future value of the asset reference crypto asset. However, white paper must clearly state that the asset reference token may lose its value in part or in full. So we all know that crypto asset markets are extremely volatile, and regulators constantly want you to warn the purchasers, the consumers, the investors of the crypto assets about that matter. The asset reference token may not always be transferable, so you may not be able to transfer your crypto asset from time to time. We cannot guarantee that. And it wants you to state that. Also, there may be some liquidation problem. Your crypto asset may not be liquid. The asset reference token is not covered by the investor compensation schemes and deposit guarantee schemes under European Union directives. Moving on, the white paper must include a statement from the company's management stating and affirming that the crypto asset white paper is, again, accurate, clear, and not misleading. After the management team statement, the asset reference crypto asset white paper must include a brief, non-technical summary that provides important information regarding the public offering or trading admission of the asset reference crypto asset. In this summary, there shall be a warning statement which basically informs the people that it is an introduction to the crypto asset and purchase decisions should consider the entire white paper, not just summary. The public offer of the token isn't a solicitation to purchase financial instruments. Again, it's actually quite similar to utility tokens. Also, one different thing is that asset reference tokens white paper must also inform the holders of the token that they can redeem at any time that backed asset, and that white paper shall specify the redemption conditions. So basically, it shall state that if you do this and in these scenarios, you will be able to redeem your assets, or you will be entitled to receive these assets. Moving on to liability arising from white papers of asset reference crypto assets. Again, in the event of information contained in that white paper is contrary to laws, regulations, and criteria set forth by MiCA and other things, meaning basically that given information is not complete, accurate, fair, or clear, then offerers or other relevant natural legal persons, even the managers or the owners of the company that developed the project, will be held liable to the holders of that crypto assets for any loss incurred due to such infringement. Again, contractual exclusion or limitation of liability stated in the white paper will have no legal effect. Last but not least, e-money tokens and their white papers. For crypto assets that fall into the scope of e-money tokens, a person shall not make an offer to the public or seek admission to trading of an e-money token within European Union, unless that person is issuer of such e-money token and has notified the competent authority of crypto asset white paper and published that crypto asset white paper in accordance with MiCA rules. A crypto asset white paper for e-money tokens, especially for e-money tokens, shall contain several information. Again, I will list these information, which are as follows. There shall be an information about the issuer of the e-money token, the e-money token itself, the offer to the public of the e-money token, or its admission to the trading, the rights and obligations attached to that e-money token, underlying technology again, and the risks that comes with that e-money token, and again, principal adverse impact on the climate. And again, this information must be fair, clear, concise, and comprehensible, void of any misleading language, and etc. Also, it shall not make any assertions to the future value of the crypto asset. Moreover, it's essential for the crypto asset white paper to contain, again, you remember the passage that I read for asset-backed reference tokens. That same passage is also required to be present in the white paper. On one other requirement foreseen by MiCA is that e-money crypto asset white papers shall contain a clear warning stating that e-money token is not covered by the investor compensation schemes and not deposit guarantee schemes. Moreover, a declaration required by the management body of the issuer of the e-money crypto asset is essentially quite similar to the declarations required for the utility tokens I just mentioned. Also, the same type of summary section is again shall be present. It's necessary. Liability arising due to e-money token white papers is actually the same with liabilities foreseen by utility tokens and asset reference tokens. Again, you will be held liable if you present misleading information. Asena, we can move on to the next slide. Sorry. Since different countries have different regulations for ICOs, actually there are no consistent legal requirements for the content of white papers. However, all countries emphasize the need for disclosure of information about the issuer and project developers, which is quite important for investors' protection. Additionally, certain legal provisions in white papers are influenced by the unique characteristics of blockchain technology. In United Arab Emirates, Securities and Commodities Authority has issued a regulation on crypto assets offerings. In this regulation, amongst other things, white papers are also regulated, but that regulation does not use the terminology of white paper. Instead, it calls these documents offering documentation, which is basically the same. These offering documentations, again, shall be clear, fair, accurate, not misleading, and etc. Moreover, the Securities and Commodities Authority of Europe, United Arab Emirates foresees a list of information that is required to be present in the offering documentation. And that offer documentation for crypto assets must include, and when and where it's relevant, following information. Since the list is quite long, I would like to directly read that to you. First of all, clarity on fund handling until crypto assets are issued. So it says that, okay, you collect the fund for the crypto asset offering, but how will you be handling these funds until you issued that crypto asset to the public? Description of all major technology related investment risk. So you may be using some advanced technology, but you will not be able to achieve your goal. So if there's a risk about that technology, you shall warn the investor about that. Furthermore, again, similar thing, explanation of the software protocols, developer, software control, implications for changes, including risks, rights and obligations of crypto asset holder. If it's an open source, a link to the code shall be present in that offering documentation. Milestones or dependencies beyond crypto asset development, timeframes for achieving project goals, how your managers will be committed to that, and if there's an incentives, what are those? Financial data about offering entity, information about crypto asset custody arrangements. So how will you be taking custody of the crypto assets? How will you be transferring them? How investors access and manage them? That technology software requirements for investors to exercise rights related to crypto assets, and again, disaster recovery, backup, intellectual property details, ownership of software, existing team and their business operations, identification of offering person, if it's a different person, the offering entity, previous investor obligations, information about outstanding token provisions, token burning, token release, token reserve requirements, third party audit details, details of compensation for management, liability and risk allocation between the offering person and software service provider, potential pitfalls and red flags. Some elements in a white paper might indicate potential problems, as I mentioned, and it's important for both readers and potential investors to recognize, as well as for the team members creating the white paper to consider carefully. A key factor to watch for is insufficient technical detail, as a credible white paper should offer comprehensive information on the project's technical aspects, such as technology use, consensus mechanisms, cryptography, tokenomics, and etc. A lack of such detail can be a significant warning sign for investors. While simplifying complex technological concepts is necessary, and actually it's quite hard, but it's crucial not to oversimplify that. Transparency about the projects and the team that develops the project and their identity, backgrounds in the white paper shall be present. Also, white paper must be original and free from plagiarism to maintain professionalism and credibility. Unrealistic promises or exaggerated claims about the project, especially in terms of technology or potential returns, can also be concerning. The white paper should provide substantial, balanced information rather than just hyping the project, which sadly we come across quite often. Carefully drafting the tokenomics section is essential, including a transparent token distribution. A concentration of tokens in the hands of a few or vague, ambiguous details in tokenomics can alarm the investors. Investors may ask, is there something wrong? Why so few people have that much token? and clarification of the project's token utility and purpose within the ecosystem is necessary to establish a clear value proposition. The white paper's role as a roadmap is fundamental. It needs to detail the project's plans, timelines, future goals. A lack of such detail can be a red flag. Adequate risk disclosure is also crucial. It's important to lend legitimacy and provide a balanced view, while a lack of risk information can lead to mistrust. Finally, the white paper must clearly address legal compliance, particularly if the project involves token sales or ICOs. Neglecting legal compliance can be a major concern, and the project must adhere to legal requirements. So, consequences of misrepresentation in white papers. Misrepresentation in white paper can have a serious legal and reputational consequences for both the project and its founders. Legally, it can lead to lawsuits from investors for fraud and misrepresentation, as well as regulatory sanction, which means that if you, as a developer or issuer of that crypto asset, and if you place misleading information, inaccurate information in your white paper, you may be accused of fraud or misrepresentation. If investors are misled, they will be suing you. Even the company or its founders. Regulatory bodies will investigate and impose penalties, halt the project, or in severe case, even bring criminal charges against those involved. Furthermore, misleading information could lead to crypto asset being excluded from exchanges and could bring about the project's abandonment if the consequences are severe and irreparable. Legal actions might require project members to compensate investors financially. You may be obligated to compensate investors' financial losses because of your misleading information. To avoid all of these unpleasant outcomes, the white paper must be transparent, provide accurate and necessary information, and most importantly, comply with relevant laws and regulations. That's it from me for this part. Thank you for listening. If you have any question, please let us know.
Thank you, Batuhan. Do you have any
You can also
questions?
take the questions at the end of the other presentation or not if you have any questions. I am seeing a raised hand.
Yes.
Yeah.
Mehmet Bey.
Hello again and good evening. Can you hear me?
Yes.
Yes.
Thank you very much one more time about your perfect information and provide us that very useful data. I want to
Thank
ask
you.
about the roadmaps. Can you give us another or some information about the roadmaps? Is it, I don't know, in the white papers, according to Mika or not, the roadmaps are should be put in there, included, or it is optional?
In terms of Mika, it is, as far as I remember, it's optional, but it's probably better to put that. But again, your roadmaps cannot be interpreted as your promise or obligation. You may miss some deadlines in the roadmaps, but in terms of Mika, as far as I remember, it is not necessary. It's optional, but actually we recommend our clients to put a roadmap because it's just lays out your plan, how will things go, what will you do in the next step, and etc. So it's actually quite useful, and it provides some clarity on your project.
Yes, that's my coming to second question, because we know that some of the projects, although it's a big projects or very valuable projects, sometimes they are changing or they are not fulfilling their the points or the which they state in the roadmaps. Is there a what is the legal situation of that if they couldn't fulfill their maps, or they change it?
Actually, it depends on how you fail that roadmap. For example, if you fail at the stage of issuing that crypto asset, you will be held liable. But let's say that you plan to provide the utility in 6 months, but there was a hiccup in your software team, developer team, and you couldn't meet that time, and you provide that utility in 9 months. So there's a 3 months of delay. In that case, you will most probably not be liable for that delay. But again, if you say in your roadmap that we will acquire these, let's say you are planning on issuing a gold-based asset, and in your roadmap says that our investors and holders of this asset reference token will be able to redeem their goals in these scenarios in 12 months, and after 3 years, and still if you can't redeem, if you can't make your promises come true and investors can't redeem their goals, then you will be held liable. So it actually depends on what are your promises, what are the milestones in your roadmaps, and how you fail to meet this. But again, if you want, we may check again. And if you have a more specific question, we will try to answer that.
Thank you very much one more time.
Thank you for your question. Is there any more question? Is there? If there is not,
We can also have questions after the other presentation. So,
Yeah, let's proceed to other presentation and we will continue and have the questions later.
okay. Real assets in a digital age. What's real world asset tokenization, and actually how does it work? Blockchain blockchain technology enables the conversion of traditional assets into digital tokens, representing different instruments like stocks, bonds, real estate, consumer loans, and art. This tokenization applies to both tangible and intangible real-world assets, like properties, bonds, commodities. Through this process, these assets can be smoothly integrated into the blockchain, revealing numerous possibilities for collaboration and new applications. Through the process of tokenization of real-world assets, market participants are able to experience enhanced efficiency, heightened transparency, and minimize instances of human errors, as these valuable assets can be stored and effortlessly traced on blockchain. Tokenized assets and securities differ from cryptocurrencies, utility tokens, and security tokens. The former are digital versions of real-world assets and securities that exist beyond the blockchain network. These tokenized items maintain a connection to their physical or external counterparts, preserving their original attributes while also integrating novel aspects provided by blockchain technology. Tokenizing traditional assets often offers several advantages, including improved efficiency, cost reduction, increased transparency, security, also even better compliance and traceability, enhanced liquidity, because more people will be joining the financial system, and facilitated innovation. These benefits stem from both the use of blockchain technology and the ability to create smart contracts and ecosystems. We will be further examining these benefits later. Asena, we can move on. Tokenization of real-world assets and securities. The tokenization of asset is a new way to represent and register property. It is important to understand its legal framework, development level, and future regulatory changes. The upcoming regulatory framework in Europe and the financial sandbox in and other countries are promising initiatives to embrace these innovative global changes. Tokenization involves using tokens as a means to represent ownership or rights to digital or a physical asset. So, the token is a tokenized asset, can be a physical asset like this telephone, or a digital art This process essentially translates assets, services, or activities into a digital format on the blockchain. Holding a token from such tokenized asset can signify partial or complete ownership of the asset that is registered within the blockchain system. So what is this tokenization and how does it work? What is that process? Tokenization can be complex, but many tools and services simplify it for issuers and businesses. There are several services online and it helps people tokenize their assets. The first step is to develop a strategy for a robust expert network for the token. Companies should evaluate the digital asset lifecycle and ensure network components are suitable. It's important to plan technical, legal, and marketing, business, and financial aspects to meet participant needs and handle unexpected scenarios as per smart contract rules. And here's a life cycle of a real-world asset tokenization. This process involves 5 main stages. First one is deal structuring. Initially, terms and conditions of real-world asset token are established. This stage is quite crucial for any token offering and it aims to improve operational process and enable financial innovation, not to bypass legal and regulatory requirements. In the second phase, information previously in physical form is transferred to blockchain and integrated into smart contracts, resulting in the token creation. Primary distribution is the third step, and tokens are distributed to investors in exchange for their capital or other resources. After the tokenization, there comes post-tokenization management in the stage. It involves managing corporate actions like dividend payments and shareholder votings depending on the tokenized asset. And these actions are often automated through smart contracts. And finally, secondary trading in this final stage, liquidity benefits of tokenization where token holders can trade their tokens with others either directly or via trading platform. And tokens grant holders specific rights like ownership or profit shares and affect an investor rights, return, and tax liabilities. Issuers must consider legal and tax implications across different jurisdictions and impact on pricing and compliance. Token classification is complex as they can embody features of various regulated instruments and their categorization can actually change, influencing regulatory obligations. Asena, you can move on to the next slide. So what are the benefits of real-world asset tokenization? First one is efficiency. Blockchain automates smart contracts, eliminating intermediaries for quicker settlements, transactions, and better management control, as you all know. And cost reduction is one other important thing. For example, for bond issuance, fundraising, the costs are like down 90%. For bonds, it's 40%. And transparency and security. Transactions are reliably recorded in the public ledger. Distributed ledger technology makes it possible, and it actually reduces disputes and allow people to straightforward editing. Compliance, smart contracts incorporate complex compliance measures, automatically ensuring adherence to regulations like know your customer, KYC, anti-money laundering, AML. Liquidity is another thing that tokenization makes even better. Investors trade previously illiquid assets in smaller units globally. For example, if you tokenize a house and that house costs $1 million, in order to make a transaction in that house, basically you will need 1 million euros, $1 million. But if you tokenize that asset and divide that asset, actually, if you issue 1 million tokens for that asset, then you will be able to transact with that asset, that house, in smaller accounts, smaller amounts, such as even $1. Moreover, innovation is another thing. Smart contracts are important in that regard. They are versatile, facilitating new financial products like fractional real estate that I just mentioned, and it actually revolutionized market tokenization democratized the investment, making it more globally accessible. And with the rise of ICOs, it combines crowdfunding with blockchain technology. Moving on, Asena, valuation of tokenized real-world assets. They have the same ability to generate cash flow as traditional assets, even more ability, more chance. However, tokenization offers added value by improving the asset's liquidity and decreasing transaction and administrative costs. These advantages should be considered by investors when valuing an asset. But how do you determine the economic value of a real-world asset? First method is net asset value, and perhaps the most common valuation method. In this financial metric, the economic value of the real-world asset token is calculated based on the economic value of the underlying and total number of issued tokens. Again, same example. There is a house which costs approximately $1 million, and if you issue 1 million real world asset token based on that house, the value of the token that you issue will be $1. So again, real-time asset pricing, one of the most common usage areas of real world asset tokens is tokenization of market instruments such as commodities, shares, bonds, currencies, and etc. These assets are already subject to first and secondary transactions. These assets prices are generally determined in accordance with the principles of free market. In the event of tokenizing these assets, the economic value of such real-world asset tokens will be determined by the actual real-world price of the underlying asset. For example, if you tokenize Apple share, then the value of your token in which you tokenize the Apple share will be equal or so close to the economic value of the actual Apple price. One other approach is income approach. The predicted income that an asset can produce is the foundation of the income approach to valuation, which is especially important for asset-backed tokens connected to income-producing assets. This involves projecting the amount of money that the asset will yield over a specific time frame. This could be real rental income or earning from a business or interest or dividends from a financial asset. In conclusion, to sum it all up, if the issuer prefers the income approach, then the economic value of the real-world asset token will be calculated in accordance with the income that the underlying asset may generate and amount it entitles its right owners. That will be it from me. Now, Asena will take over and tell us about regulations across major jurisdictions.
Thank you. Hi, welcome back everyone to me. Okay, I will start with regulations across jurisdictions. Let's start with USA. So the top dog authority in the USA is the Securities and Exchange Commission, aka the SEC. We will call them SEC from now on. They're mostly focused on figuring out if certain crypto assets should be considered securities or not. So in order for the SEC to take action against a crypto asset, it needs to be considered a security. But how does the SEC decide if a crypto asset is a security? Well, they use something called the Huey test. We talked about this before in our other workshops as well. Basically, this test was created by the US Supreme Court to see if a transaction can be classified as an investment contract and therefore a security. So according to the Huey test, an investment contract exists if there is a financial commitment, a common enterprise, an expectation of profit, and the profit comes from the efforts of others. So if these requirements are met, then the asset in question will be considered a security, and therefore a security law will apply. Tokenizing real-world assets involves transferring ownership or rights to a digital token on a blockchain. So these tokens often represent investments in things like precious metals, gold, real estate, artwork, or other financial ventures. So let's examine each requirement and how it relates to tokenizing real-world assets and the potential use of the Huey test. So when real assets are tokenized, investors typically purchase tokens that represent a portion of the asset by contributing financially. This is because buying tokens gives investors' rights or interests in the underlying asset, which is what they usually want. So tokenized assets often involve a shared enterprise because the value of the tokens are linked to the performance of underlying asset. So if the asset's value increases, all token holders benefit proportionally. This meets an important aspect of the Huey test, which assesses whether an investment is a security or not. So investors in tokenized assets typically expect to make a profit, which can come from various sources, such as token value appreciation, rental income, dividends, or other returns. So tokens that are marketed with the promise of profit can fulfill this requirement. The involvement of others' efforts is also very crucial. If the predicted benefit from a tokenized asset relies heavily on the efforts of individuals or companies managing, producing, or promoting the asset, then this creation criteria is met. So, for example, if a tokenized real estate investment depends on a management firm to renovate a building, for example, finding tenants and handle maintenance to generate rental income, the activities of those third parties are essential for token holders to achieve the expected profit. So if a tokenized asset meets all 4 elements of the Huey test, it is very probably likely to be considered as a security and subject to regulatory obligations from the SEC or other regulatory bodies, such as registration or obtaining an exemption. So when the SEC determines that a real-world asset token is a security, it creates issues for the token's issuance, offering, and trading. So securities are subject to strict regulations and must be registered with the SEC unless they meet certain exceptions. This registration process also involves providing detailed information about the company's activities, finances, let's say management and investment risks. So failure to properly register a token that could be considered a security can result in very serious violations of securities laws. For example, in the case of, there's this case with Binance and the BMA trading, they were accused by the SEC of providing securities market functions without registering, and Binance itself was found to be operating without proper registration. So these actions violated multiple sections of the Exchange Act. Additionally, Zhao, as the person in control of Binance and the BMA trading, was also found to be involved in these violations. So the SEC said that Binance broke the rules by offering and selling BNB, BUSD, Simple Earn, and BNB Vault without registering them. So they claimed Binance was directly violating the regulations. Okay, let's move on with the European Union. So I will talk about MiCA as well again, and I will refer to asset reference tokens, which we call real world asset tokens. I will call them ARTs from now on, if you can follow up on that. Let's continue. Okay, so the Markets in Crypto Asset Regulation, MiCA, will be implemented in December 2024 and is of great importance to investors and issuers in the blockchain and crypto asset industry, particularly regarding asset reference tokens. ARTs. Okay, so MiCA sets out the requirements for ARTs and its regulatory framework in European Union member states. So ARTs are defined as crypto assets that maintain a stable value by referencing another value or right. So MiCA's Title 3 consists of 6 chapters covering the authorization, obligations of the issuers, reserve of the assets, accusations, significant ARTs, and the recovery and the redemption plans for ARTs. And for more, I would require you to see our paper and also see for yourself the articles of the MiCA. But I will give detail about authorization and obligations of the issuers, reserve assets in this paper. Okay, so let's talk about authorization. Credit institutions can offer the ART to the public or have it traded by following certain procedures. So they must prepare a crypto asset white paper, get approval from the relevant authority in their home country, and notify the respective authority, as I remember, at least 90 working days before issuing the ART for the first time. So this notification should include specific information as required by MiCA. However, these authorization requirements do not apply if the total value of ART issued is less than 5 billion euros over a 12-month period, and the issuer is not associated with a network from exempt issuers. So the requirements are also not applicable if the offer is exclusively for qualified investors. The only issuers who meet certain criteria, such as being a legal entity established in the European Union and authorized by a competent authority, can offer the art to the public or seek its trading. Alternatively, credit institutions that comply with MiCA can also be issuers. The non-European Union entities can issue arts if their legal structure provides equivalent protection and they're subject to equivalent supervisions. Okay, so let's talk about obligations of the issuers. MiCA also aims to regulate and ensure the trustworthiness of entities issuing asset reference tokens, as I mentioned, arts, in order to protect investors. So the regulation also requires arts to have asset reserves to safeguard investor funds, because framework provides transparency for investors, allowing them to make informed investments and monitor the performance of arts. So the regulation also governs the handling of complaints by issuers, requiring them to have clear governance arrangements and procedures in place. So issuers are required to report quarterly to the competent authority on various aspects of their arts, including number of holders, value of the art issued, what else? Size of the asset reserve and transaction informations. So MiCA sets requirements for issuers, such as being a legal entity established in the European Union, authorized by a national competent authority, and holding a credit institution authorization. So issuers must also have sufficient funds and regularly publish reports on the arts, reserve assets, circulating tokens, and fees charged. So according to Article 36 of MiCA, tokens that are linked to assets must have a reserve of assets to protect token holders from risks and liquidity problems. So this reserve must be separate from the issuer's assets and other token reserves in order to safeguard holders in the event of insolvency or liquidity. So a crypto asset service provider can be hired to handle and store the reserve assets securely. It is crucial that the custodian is an independent entity with the necessary expertise and reputation. They will keep through the records and provide regular reports to the issuer. So the appointment of the custodian must be formally documented as well in an agreement that specifies their rights, responsibilities, and protocols for managing the reserved assets. MiCA also takes into account important arts, which will be determined by the European Banking Authority. So the significance of these arts is determined by by factors like their size, the numbers of investors, and the level of risks that may be involved with them. So while issuers can classify their arts as significant voluntarily, it's worth noting that doing so comes with extra responsibilities, like following additional guidelines from the European Banking Authority on managing reserve assets and protecting investors. Furthermore, issues of significant arts will be monitored by the European Banking Authority all the time. Okay, so when publishing a white paper for an asset, for an art, the approved version should be available on the issuer's website. It should remain accessible as long as the art is in circulation. Marketing communications related to art should also be published on the websites of those offering or seeking admission to trading. So these communications should be made well in advance of offering the art to the public, ensuring the public receives the relevant information in a timely and transparent manner. So regulations are in place to govern the marketing aspects of arts, including the content of white papers and marketing communications. So the white paper should provide fair, clear, as Batuhan mentioned all the time, and not non-misleading information with sufficient details for the benefit of investors. So it should be the official language of the issuing member state or commonly used in international finance. Any changes to the business model that could impact art holders' decisions must be also reported to the appropriate authority. While there is no requirement for pre-approval of marketing communications, it's crucial for them to be transparent and avoid misleading individuals. They should also align with the information provided in the white paper. So if requested, marketing communications must be promptly shared with competent authorities to ensure transparency and regularity compliance. Let's talk about Turkey. So in Turkey, there are no specific laws regarding crypto assets, so we need to refer to relevant local laws based on the nature of the crypto asset. So depending on the type of tokenized real-world asset, the applicable laws may vary a lot. So if a tokenized real-world asset falls into the categories of securities, derivative instruments, or investment contracts, it will likely be subject to Turkey's strict securities laws, so making it challenging to develop a token for it. So tokenized real-world assets are often used similarly to derivative instruments in capital markets. So if a real-world asset falls into any of these categories, the capital markets law will apply, and offering or trading such tokenized assets without compliance can have major legal consequences. So tokenizing lease certificates or precious metals like gold is a common practice, but it requires obtaining necessary permissions and approvals from the board and according to the capital markets law, and there are licenses and certificate requirements for such. For now, let's talk about real estate tokenization in Turkey. For now, there is no obstacle to the debtor fulfilling their obligation with token at the end of the tokenization and exchange transactions, which are essentially external transactions dependent on the debtor's actions. However, finding a solution to ensure the functionality and trustworthiness of these external real estate tokens, such as through trusts or escrows, may raise debates about comprising the decentralized nature of the blockchain. Let's move on with the United Arab Emirates, Dubai. The United Arab Emirates is making a big move in the crypto asset industry. So in a recent decision, they defined security tokens as securities and outlined the types of financial instruments that fall under this category. The companies looking to use blockchain or new technologies for fundraising should probably reach out to the Financial Services Regulatory Authority in Dubai for guidance. So it's important to determine if a real-world asset falls under capital markets law before tokenizing it in the United Arab Emirates. So the country is, we can say that the country is a real leader in real estate tokenization, with real estate investment funds being tokenized. So if these tokens are considered securities, they will be subject to the same regulation as traditional securities. But for now, it can be recommended to do those tokenizations in Dubai. Let's move on with real-world assets as option agreement. So what is an option agreement? An option agreement is a contract between two parties that allows them to potentially trade an asset at a specific time and for a price. So options are financial tools tied to the value of stocks or other assets. So the agreement gives the buyer the right, but not the obligation, to buy or sell the chosen asset with a certain period. There are two common types of option agreements. First, call options. They allow the buyer to purchase the asset at a set price, while put options allow the buyer to sell the asset at a predetermined price. So option agreements are often used in situations such as landowners and developers making agreements for the purchase of land within a specific time frame. Another question is, can real-world asset tokens can be considered as option agreements? So if a real-world asset token meets the criteria of an option agreement, which means it allows its owner to buy or sell a specific asset at a set price with a certain time frame, then it can be seen as an option agreement. So in the United States, options are typically classified as securities according to the Securities Act and the Securities Exchange Act. So this is because options allow individuals to purchase or sell assets such as stocks at a predetermined price before the option reaches its expiration date. In the US, options are controlled by the SEC and are traded on regulated exchanges. There are also over-the-counter options that are still considered securities and may have additional regulatory requirements unless they're exempted from them. So in Turkey, the Capital Markets Board governs the financial markets, and securities, including options, are defined by the capital market law. Standardized options traded on exchange like Borsa Istanbul are considered capital market instruments and are regulated by the Capital Market Board following Turkish capital market laws. So some types of OTC options, which are standardized or traded on a formal exchange, might still be considered securities, or capital market instruments, depending on how they are structured and rights they give. Let's talk about the challenges that await the real-world asset tokens. So tokenization is a promising solution for investing challenges, but it is still in its early stages and has some concerns. So security tokens, which are different from the traditional assets, are a new and untested area of law and regulation. While regulatory authorities have given some guidance, there will likely be ongoing developments and changes as technology and the market advance. So there is also no guarantee that regulators supporting tokenization now will continue to do so in the future. So real estate tokenization, for example, poses many challenges regarding confidentiality, as only a select group of investors are typically given access to sensitive information. So the laws and regulations governing security tokens may change, creating uncertainty for issuers and investors at this area. So some jurisdictions differentiate between security tokens and crypto assets, with security tokens being backed by real assets and having less volatile value. These tokens are usually regulated under existing securities regulations. In the past, real estate transactions were confidential, but with security tokens traded on exchange, sensitive information must be disclosed to a wider pool of potential investors. So striking a balance between data transparency and information privacy will be crucial in blockchain technology development in this area. So protocols like zero-knowledge proof can protect data privacy while enabling transparency and preserving confidential business data. Let's move on with the case studies. Real estate tokenization. Let's say a local company owned by an offshore company will handle all the property management tasks for a real estate project. So the current owners will still have majority control, but will convert some of their ownership into tokens that will be given to smaller investors. So this will allow investors to participate in the real estate market with less money upfront. So using blockchain technology will make the process of changing ownership and selling, for example, an hotel faster and more secure. The investors will also have the ability to trade their tokens with others, making it easier to sell their investment if desired. Let's also talk about fund tokenization. So investors in the fund are generally given digital tokens to represent their ownership. While they cannot withdraw their investment until it matures, they can sell their tokens to other investors on the secondary markets. So this has encouraged other asset managers in Asia to tokenize their funds. Tokenization is expected to become more popular, especially for closed-end funds, as it offers benefits that attract a wider range of investors. So the fund manager uses a technology platform to convert equity interest into tokens, providing trading and liquidity in the secondary market. Let's say this fund is the first in a series that focuses on investing in difficult to sell assets. It is structured within the segregated portfolio company in the Cayman Islands, offering advantages in time and cost. So the ownership of equity interests is recorded in the fund's register, maintained by the administrator through a book entry ledger and a blockchain-based ledger. In 2019, there is this example. There is someone called Sidley assisted a Hong Kong fund manager in creating the first tokenized fund in Asia, which invests in liquid assets like real estate. So the fund will remain active for a period of time to allow the managers to buy, increase the value of, and sell these investments. So investors are restricted from selling their shares and withdraw their money at will. We have some current examples right now. Our first example will be Riental. It's about real estate. So there's a company called Riental in Spain that lets regular people invest in real estate. So you can buy a piece of property for just like 100 euros, let's say, and get paid every month from the rent. After 2 years, they sell the property and they give out any profits to the people who bought tokens. And the best part is, Riental makes it easier to sell your investment by using special finance systems, so you can trade your property tokens for real money. Real estate investments can be tough to get into and not very easy to sell quickly, so you usually have to put down a lot of money and have good credit to get a mortgage. It's also not easy to share ownership of a real estate with others because of all the expensive legal stuff involved, such as consultancy, agreement signing, and etc. Okay, another example is AgroToken, which is related to commodities. So AgroToken is a cool platform that lets you turn stuff like wheat, corn, and soy into tokens. So basically, farmers give their crops to a custodian who gives them tokens that represent how much grain they deposited. So you can trade these tokens on the platform or with other people. The price of tokens are set by the market and watched over by the oracles connected to the commodities markets. So if you have these tokens, you can trade them in for a real grain, which means the tokens get destroyed. And last example, so in September 2019, Santander Bank did something pretty cool. They became the first bank to issue a bond using a public blockchain. This bond was worth a hefty 20 million, I would say, and had a coupon rate of, I don't remember the rate right now, 1.90% or something per quarter, and it was also tokenized. So Santander Securities Services played a big role in making sure this bond was safe and secure. So the bank says that this new way of doing things has some awesome perks like more transparency in the market, faster settlement times, better security, and less need for middlemen. And also that was it for me. And if you have any questions, we would like to have them. We had a lot of legal things to say and explain, so there can be many details to it. Regarding MiCA, I would say, I would recommend you to check up on them, the regulation and the articles of it, for white paper and also for both real estate, real world assets of crypto assets. Yeah.
Thank you very much, Asena and Batuhan. So if you have questions, it's the correct time to ask them.
Hello again. I want to ask a question about anonymity sites. As you know, the nature of the blockchain is the anonymity and the decentralization. If I want to invest or make a trade about the real world asset, because all of us know that most of the crypto players are saying that real world asset will be the next hype of the blockchain ecosystem. If I want to make an investment or if I want to make a trade, do I have to, or will I have to reveal my identity, my ID, or it will be the same as a DeFi?
Actually, it depends on the tokenized asset. If, for example, if the real world asset is real estate, then in order to prove that you are the owner of that real estate, and for the legal compliance matters such as I can't remember the English name, but tapu müdürlükleri, sicil, and etc. and the governmental authorities that keep record, you will be required to reveal your identity. But for bonds, you may not need to reveal your identity. You may remain, I would say. But again, it depends on the forthcoming regulations and mostly depend on real estate. Real world asset.
And how about the regulatory side? I mean, for example, in regarding with MiCA, are we have to reveal our identity regarding MiCA?
No, MiCA actually do not require. Actually, it doesn't say anything about that matter, as far as I am
You
concerned.
may be required to reveal yourself, your ID or information if they request you to, or if you are requiring something from the real estate or example real estate, because as you know, real estate has to be owned by someone, and like if you are another owner, it should be registered as well. So that's a confliction there. So we don't know yet. We don't know yet, but I think that's a nice question, and we will see conflictions based on this, because you have to prove your ownership of the real estate, and how can you prove that? I mean, if you're anonymous, if you're anonymous, you cannot prove that. And if someone is selling your real estate without consulting you before or letting you know, and
actually, I'm sorry for interruption. Actually, there are some solutions about to identification of proof of identification. For example, the Polygon company trying to solve this kind of issues. only that company know your identity, but the issuer of the or another organization don't know about your ID.
Okay,
But
that can be
again, that company
sure.
do not have any authority over legal matters, so it doesn't really make any change. Again, if
Well, if the
you
company
come into a
acknowledges
dispute with
your,
someone else, and if you go to court, the court will
how
then
are you
ask
going to
that
prove?
company
Yes.
to reveal your identity. The fact that only that company knows your identity and does not reveal your identity doesn't actually make any difference, because when it
It will,
comes to need of revealing your identity, you will be entitled, you will be required to reveal. And also, MiCA and other regulations and directives in some matters require issuers and investors, even crypto asset server providers and etc., to comply with know your customer and anti-money laundering procedures, in which case your identity will be most probably revealed and collect and processed, and if it's needed, it will be shared with third parties such as governmental organizations or relevant bodies.
I would say if there's a confliction before a court, even if the company knows your identification, they may not reveal or they may not know you. I mean, they have to store that knowledge, but even if it was requested by the court for the company to share, they may not share it, and they may say, oh no, we don't know this person or something else. That what comes to my mind at the first instance. Maybe we can prove that since these things are recorded on the blockchain, but it will require, I'm talking about Turkey, it will require a great knowledge for the court and the judges to have.
Yes.
And that's not likely to happen in Turkey for a long time.
Yes, you're right. My second question about the Turkey as well. Maybe it's a general question because you already mentioned about it. Turkey, it's a problematic issue about the regulation for the crypto asset in Turkey. Do you think Turkey regulations or Turkey laws are how ready to this real world asset tokenization?
Well, they are not as many as other jurisdictions. They are worldwide, I'm talking. No one is right now ready for such regulations or implementing them. Even Turkey is very kind of behind and have some different approach from other jurisdictions as well, which can be similar, but there are a lot of loopholes, and like there are stuff that cannot be backed up by the regulation, which is also in practice. So we will see if we have, as I have to mention as well, regardless of the regulations that we have, the courts basically depend on the decisions of other courts as well. So we don't have an example for a court's decision yet. And if there will be one, it will be the first one, and they will probably keep applying that one. So we have to also, other than the regulations, we have to also look at the court decisions that they will build and conclude. So there's that.
Actually, I don't really agree with Asena.
Okay.
I think Turkey's law makes it possible to tokenize many assets. You may issue a gold-backed token. It's actually possible, or you may even tokenize a real estate, even though
You
it's
can,
possible by
but
law.
there are requirements for it: KYC, AML, everything, and they also
Yes, it's possible, but
okay. Come on.
governmental authorities do not understand the technology, and therefore
Yes,
they
that's what I
can't
meant.
comprehend it is actually legal. And also they are so afraid of taking a decision. Also, I just can't tell you. Yani, it's hard to negotiate with them. They're so afraid to take incentive.
Yeah, I think we're gonna implement something from outside world. Well, there will be a nice regulation, and then we will probably kind of copying it and then try to make it work here, which will create loopholes in our systems, because other local laws that we have, they will probably conflict with the laws we will get from other jurisdictions. So that's what we do. But thank you, Batuhan, for not agreeing with.
I think Mr. Batuhan is very right about that, because we know we have some ruling men. I don't need to mention about the names or the rank, because
Legal
they are
purposes,
saying
let's say.
yes, we can say that, because as I think you remember, they are saying that they will keep to fight with the blockchain and the crypto.
Yes, true.
Unfortunately.
Yeah, but we will see what it brings.
Yes. Thank you very much
Yes.
one more time.
Of course.
Our
Thank you.
regulators are reactionary. If there is no problem, they will not see that opportunity, and they will only act when there's a scandal or enormous kaybı and
Even
etc.
big, enormous things. What happened before? FTX,
They
for
just
example.
ban the whole thing.
Yes, exactly. We will see
Okay.
if we're those.
See you in next workshops. Thank you for your participation.
I don't think we have any further questions.
Yeah.
No, I don't think so.
Okay.
Yeah, we will be ready with new topics next month. So see you next month on another Little Fish Foundation workshop. Bye bye.
Thank you very much all for
Thank you.
participating. It was nice. Very fun.